You know that feeling when you find a $20 bill in an old coat? It's great, right? But what if I told you that some of that found money and a bunch of other things you'd never expect could actually end up on your tax return? Well, today we're taking a tour of the most fascinating and honestly surprising page of your tax return, the world of other taxable income. Let's dive in. So, to get us started, I've got a little riddle for you. What in the world could a huge casino jackpot, a forgiven loan from your credit card company, and the paperwork from a divorce possibly have in common? I mean, they sound like they're from totally different planets, don't they? And the answer, believe it or not, is that they can all show up on the exact same page of your tax return. It's a special form called Schedule 1. You can kind of think of it as the IRS's junk drawer, the place where all the odds and ends of your financial life end up, especially the income that didn't come from your regular paycheck. All right, so on our little tour today, we're going to make 3 big stops. First, we'll tackle the gambler's tax mill. Then, we'll get into the very weird concept of forgiven debt actually being income. And we'll wrap up by sorting out the rules around alimony, which can get pretty tricky. Okay, first stop, the high-stakes showdown between good luck and the tax man. You hit the jackpot, you're on top of the world, but Uncle Sam is right there waiting for his share, and you really need to know the rules of this game. So, here's the number one thing you've got to remember, and it's brutally simple. All winnings are 100% taxable. I don't care if it's from a lottery ticket, a little church raffle, a horse race, or a slot machine in Vegas. If you won it, it counts as income and you have to report every single penny. But this is where it gets really interesting. See, you have to report all your winnings, right? But what about your losses? Well, that's a whole different story. You can only deduct your losses up to the amount you won. So if you win $1,000 but lose $2,000, you can only deduct $1,000. And here's the real kicker. You can only claim those losses if you itemize your deductions. If you're like most people and take the standard deduction, well, those losses do absolutely nothing to help your tax bill. Let's make this real with an example. Meet Deirdre. She had a pretty good year, winning $11,000, but she also had a bad year, losing $23,000. Now, you'd think that she's down 12 grand, so no tax, right? Nope. Because of that rule, her deduction for losses is capped at her winnings. So she can only deduct $11,000 of her losses, and again, only if she itemizes. This is a huge trap a lot of casual gamblers fall into. All right, let's move on to our next stop, which is maybe the weirdest of them all. I call it ghost debt. This is when money you didn't have to pay back mysteriously materializes on your tax return as income. It's a real head-scratcher. The official name for this is cancellation of debt income. And yeah, it feels totally backwards, doesn't it? Why are you being taxed on money you never actually got to keep? Well, the IRS sees it this way. You received an economic benefit because you were freed from the legal responsibility of paying that money back. So imagine Edith. She runs up $10,000 on a credit card. She manages to pay back $2,000, but then things get tough and she just can't pay the rest. If the credit card company eventually gives up and writes off that remaining $8,000, guess what? That $8,000 can show up as taxable income for Edith that year. Now, that sounds incredibly harsh, especially for someone who's already in a tough spot financially. So it begs the question, are there any escape hatches? Are there exceptions to this rule? And thankfully, the answer is a big yes. The IRS does have some major exceptions built in. For instance, debts that are wiped out in a bankruptcy don't count. But the most common one for people who aren't in a formal bankruptcy is a situation called insolvency. Insolvency isn't just a feeling. It's a very specific calculation. It means that in the moment right before that debt was officially canceled, the grand total of everything you owed was more than the grand total value of everything you owned. Let's look at Rocio's worksheet to see how it's done. To prove she was insolvent, she had to draw up a personal balance sheet. On one side, she listed the value of all her assets, her condo, her car, her IRA, the whole shebang, which added up to $228,600. Then, on the other side, she listed all her debts, mortgage, student loans, credit cards, which came out to $276,000. So you see the difference there? Her debts were $47,400 more than her assets. She was insolvent by that amount. Now, the debt that got canceled was $20,000. And because that $20,000 is less than her insolvency amount of $47,000, she gets to exclude the entire thing from her income. It's not taxable. This is a really critical safety net. It stops the tax code from kicking people when they're already down. All right, on to our final stop on this tour, the Great Alimony Tax Divide. And this one is truly a tale of two different tax universes. The crazy thing here is that the most important detail isn't how much alimony was paid, but when the divorce was finalized. That's it. The date is everything. See, a few years back, a new tax law came in and just blew up the old system. For any divorce that was finalized before January 1st, 2019, you're in the old world. That means the person paying alimony gets to deduct it from their income, and the person receiving it has to claim it as taxable income. But for any divorce finalized on or after that date, the rule is completely flipped. The payments are not deductible for the person paying, and they are not taxable for the person receiving them. It's a complete 180. Let's just look at how this plays out for two couples. Tegan and Patsy got divorced in 2017. They're under the old rules. Tegan pays $18,000 a year in alimony, and he gets to deduct that full amount on his tax return. Patsy, on the other hand, has to report that same $18,000 as income and pay tax on it. Now look at Connie and Derek, who got divorced in 2024. Derek pays alimony, but he gets zero tax deduction for it. And Connie? She receives that money completely tax-free. Same situation, totally different tax outcomes. Now, there is one thing that has stayed the same through all of this, and it is super important not to get this confused with alimony: child support. Child support is never deductible for the person who pays it, and it is never taxable income for the parent who receives it. That rule has not changed. And there you have it. That was our whirlwind tour of some of the biggest and most common surprises you'll find on Schedule 1. So after all that, what are the big ideas you absolutely need to walk away with? Okay, if you only remember three things, make it these. First, with gambling, just assume your winnings are taxable, period. And remember that deducting your losses is way harder than you think. Second, canceled debt can be a shocking source of income, but always check for those exceptions, especially insolvency. It could save you. And finally, for alimony, it all comes down to the date on your divorce decree, before 2019 or after 2019. That single fact changes everything. You know, what we covered today is really just the tip of the iceberg when it comes to Schedule 1. It really makes you stop and think, doesn't it? What other hidden income rules, things we didn't even have time to get to, might just be waiting to have an impact on your next tax return?